What happens when the world's safest asset suddenly becomes the most uncertain trade on the market? What happens when the charts flip upside down and the support levels we trusted start to crack? Ladies and gentlemen, welcome back to the channel. Today, we are not just looking at numbers, we are dissecting a critical moment in the history of gold prices. If you have been watching the markets this week, you know exactly what I am talking about. We have seen volatility, we have seen confusion, and most importantly, we have seen a sharp bearish reversal that has left traders scratching their heads. Is the bull run over? Or is this just a massive trap set by institutional investors to shake out the weak hands before the next leg up? Today, we are diving deep into a comprehensive analysis of gold's current price action. We are going to take a specific article, a forecast that highlights this rising uncertainty, and we are going to break it down, line by line, level by level. We are talking about key support zones, the battle at the 50-day moving average, and why the 4,400 mark might be the most important number you need to watch right now. But this video isn't just for the pros. If you are new to trading, or if you just want to understand where the economy is heading, you need to watch this. We are going to expand on the technical concepts mentioned in the forecast, moving averages, Fibonacci retracements, and channel breakouts. So by the end of this video, you won't just know what gold is doing, you will understand why it is doing it. So, grab your notepads, open your charting software, and let's get straight into it. This is your ultimate gold price forecast. Let us start with the headline of the situation we are currently facing. Uncertainty rises after bearish reversal. Now, in the world of financial markets, the word uncertainty is actually a technical term in itself. It doesn't just mean we don't know. It means the market is in a state of equilibrium between buyers and sellers, where neither side has total control. This is dangerous territory. Why? Because uncertainty usually precedes a massive breakout. It's the calm before the storm. Our analysis begins with the observation that gold is experiencing heightened uncertainty. This isn't a surprise. In fact, it is exactly what you should expect after what happened last week. Let's rewind a bit. Last week, we witnessed a bearish reversal. For those of you who are new to technical analysis, let me explain what that means in plain English. A bullish trend is when prices are making higher highs and higher lows. Everyone is happy, money is being made on the upside. A reversal occurs when that momentum stops and flips. The buyers get exhausted, and the sellers step in with force. Last week wasn't just a small dip, it was a sharp reversal. This kind of move damages the psychological confidence of the market. When traders see a sharp drop, their first instinct is fear. They ask, is the top in? And that fear drives the uncertainty we are seeing this week. Currently, prices are testing a well-defined support zone. Now the phrase testing a support zone is crucial. Imagine a floor in a building. You can jump on it, and it holds you up. That's support. But if you jump with enough weight, or if you bring a wrecking ball, which is what the sellers are doing right now, that floor might crack. Traders right now are sitting on their hands, watching for one of two things. Consolidation. This means the price moves sideways, taking a breather. Renewed upside momentum. This means the floor holds and we bounce back up. But here is the catch, and this is what the data is telling us. The market hasn't decided yet. And that indecision is where you can lose the most money if you aren't careful. Let's get into the specific numbers, because numbers don't lie. The analysis highlights that a new retracement low of $402 was hit on Monday. First, we need to understand the concept of a retracement. In a healthy market, prices don't go up in a straight line. They go up, they pull back, retracement, and then they go up again. This allows the market to breathe. However, when a retracement goes too deep, it threatens to turn into a full-blown crash. Hitting $402 on Monday was a critical test. This level wasn't random. The market found support right near the 50-day moving average. Let's take a quick educational detour here. What is the 50-day moving average, MA? Simply put, it is the average closing price of gold over the last 50 trading days. Institutional investors, the big banks, the hedge funds, they love this line. They use it as a benchmark for the medium-term trend. If the price is above the 50-day MA, the trend is considered healthy and bullish. If the price drops below the 50-day MA, alarm bells start ringing. So, when gold hit $4,402 on Monday, it was essentially kissing this 50-day moving average. It was a moment of truth. The fact that it successfully found support there is a good sign for the bulls. It means that there were enough buyers waiting at that specific average price to step in and say, no, we are not letting it fall further. However, we have to look at the context. That $4,400 level was a 4-week low. Think about that. For an entire month, gold had not been this cheap. On one hand, that looks like a discount. On the other hand, it shows weakness. It erases weeks of progress in just a few days. This drop also put the price of gold near a recent breakout level from a rising trend channel. Imagine a river flowing uphill between two banks. That's a rising trend channel. Gold had previously broken out of this river, surging higher, but now it has fallen back to the edge of the riverbank. This is what technicians call a retest of the breakout. Often, when a price breaks a resistance level, that resistance turns into support. The fact that gold is hovering near this breakout level is the market checking to see if the previous breakout was real or if it was a fake out. So, Monday gave us the low, but what happened next? The bounce. After hitting that low of $4,402, the market tried to recover. We saw a bounce. But, and this is a very big but, the quality of the bounce matters more than the bounce itself. The analysis tells us that the bounce that followed found resistance at a high of 4,092 on Wednesday. Note to viewer: if we strictly follow the user prompt's text, the number is 4,092. However, logic dictates a bounce from 4,402 would be higher, e.g. 4,492. For the sake of the script, we will analyze the concept of lower highs and assume the resistance was a lower level than the previous peak. Let ES focus on the key technical takeaway here. The bounce failed to reclaim the high ground. Specifically, the article notes that gold closed below the 10-day average. We just talked about the 50-day average being the medium-term trend. Well, the 10-day average represents the short-term momentum. It's the pulse of the market right now. When the price tries to rally but gets rejected and closes below the 10-day average, it tells us that the short-term momentum is still bearish. The sellers are aggressive. Every time the price pops up a little bit, someone is selling into that strength. This creates a scenario where the price is squeezed. Below, at $4,402 and the 50-day MA, you have buyers trying to hold the line. Above, at the 10-day MA, you have sellers pushing it down. This squeeze is exactly why the headline says, "Uncertainty rises." The market is trapped between these two dynamic lines. Let's dissect the psychology of the Wednesday close. Wednesday is the middle of the trading week. It's often a pivot point. The fact that gold couldn't muster enough strength to close above the 10-day line on a Wednesday signaled to traders that the weakness wasn't over yet. It wasn't just a manic Monday panic sell. It was sustained weakness. This brings us to the concept of the first pullback. The report states, this week was the first pullback following last week's trend reversal. Why is the first pullback so dangerous? Because when a trend changes, the first pullback is usually where the denial phase kicks in. Bulls who miss the top are hoping it goes back up so they can sell. Bears who miss the breakdown are waiting for a small bounce so they can short the market. This convergence of hope and fear creates jagged, unpredictable price action. And that is exactly what we saw leading into Thursday. The analysis mentions that on Thursday, gold triggered a one-day bearish reversal below Wednesday's low. This is classic technical trading. If Wednesday's low is breached, it triggers stop-loss orders. Traders who bought the dip on Monday or Tuesday likely put their safety nets, stop losses, just below Wednesday's low. Once the price dipped below that, snap, those sell orders triggered, adding fuel to the fire. This pushed the price back below the 20-day average, showing further weakness. Now we have lost the 10-day and we have lost the 20-day. The layers of defense for the gold price are being stripped away one by one. So, where does that leave us as we wrap up the first part of this analysis? We have a market that is bruised. We have a market that has lost its short-term momentum indicators, the 10-day and 20-day averages. And now, all eyes are turning back to the heavy lifter, the 50-day moving average. The report explicitly states, this puts the 50-day average in sight as another test of the line may occur. This is the showdown, the battle of the 50-day. If this line breaks, the narrative changes from correction to bear market. If it holds, we could be looking at the buying opportunity of a lifetime. But there is a twist. The volatility we are seeing, the erratic up and down movements, might actually be a clue. The text suggests that given recent volatility, a dip that generates a higher swing low could result in a second leg up from the bottom. This is the bullish hope, a higher swing low. In part 2 of this video, we are going to go even deeper. We are going to look at the cluster of support, why multiple indicators are lining up at the exact same spot to save gold. We are going to talk about Fibonacci retracements, the rising channel, and the specific price targets you need to set on your trading platform for the coming days. We are also going to discuss the confluence factor, why the $4,425 level is mathematically critical. You do not want to miss the next section. We are moving from identifying the problem to analyzing the potential solutions the market is offering. Stay tuned because the chart is about to get very interesting. If you take only one thing away from this video, let it be this word, confluence. In trading, reliance on a single indicator is risky. Maybe the moving average says buy, but the trend line says sell. That's confusion. But confluence is when multiple independent indicators all point to the exact same price level at the exact same time. When this happens, that support level becomes like a concrete wall reinforced with steel. It is much harder to break. The analysis we are dissecting today highlights this perfectly. The report states, multiple indicators reinforce current support zone. It goes on to say, there are several indicators alerting to the support zone seen this week. That suggests that it should hold for now. Let's break down what these multiple indicators actually are in this specific gold setup. According to the data, we have a trifactor of support, the 50-day moving average, which we touched on in part 1, the top of a rising channel, previous resistance turning into support, the 88.6% Fibonacci retracement level. Let's analyze each one of these individually to understand why their combination is so potent. First, let's look at the rising channel. The article mentions the top of a rising channel that represented resistance previously was recognized as support. This is a classic example of the principle of polarity in technical analysis. Imagine a ceiling in a multi-story house. You are on the first floor and you keep bumping your head against the ceiling, resistance. You can't get through, but finally you find a ladder, you smash through that ceiling, and you climb up to the second floor. Now, that old ceiling is beneath your feet. It has become your floor. Support. Gold spent weeks, maybe months, inside a rising channel. Every time it hit the top of that channel, it got rejected. That top line was the ceiling. Recently, gold broke out above that channel. It smashed the ceiling. Now that prices are falling back down, they are landing on that exact same line. The market is testing the structural integrity of this new floor. If the price bounces off this line, it confirms that the breakout was legitimate. It tells us that the market has accepted this new higher price range as the new normal. However, if price crashes back inside the channel, it's called a fake-out or a failed breakout. That is usually a very bearish signal because it traps all the buyers who bought at the top. But right now, the report is optimistic. It says the line was recognized as support. This means traders saw the line approaching and placed their buy orders right there. They trust the floor. Now let's add the next layer of our concrete wall, the Fibonacci retracement. Specifically, the report identifies the 88.6% retracement of the recent internal upswing at 4,125. For those new to Fibonacci, these are mathematical ratios derived from nature that appear everywhere, from the spiral of a galaxy to the petals of a flower, and yes, to the psychology of human trading. Traders typically look at the 38.2%, 50%, and 61.8% levels. These are the standard pullbacks. But the 88.6% level, that is the last stand. This level is derived from the square root of 0.618 and then square rooting it again. It's deep math, but here is the practical application. The 88.6% level is often called the deep crab pattern level in harmonic trading. When a price retraces, pulls back 88.6% of its previous move, it means it has given back almost all of its gains. It is hanging by a thread. However, because it is the last line of defense before a full 100% reversal, algo bots and high-frequency traders often have massive buy orders sitting there. Why? Risk to reward ratio. If you buy at the 88.6% level, your stop loss is very tight, just below the 100% low. But your potential reward is a rally all the way back up. It's a trade with very low risk and very high potential reward. The fact that this 88.6% level sits at 4,425 hours is crucial. Remember the low we talked about in part 1, the Monday low of $4,402. Notice how close these numbers are: 4,402, $4,425. In the grand scheme of gold prices, a $20 difference is nothing, it's noise. So we have a zone of support between roughly $4,400 and $4,425. So let's stack them up. At this specific price zone around $4,400, $4,425, we have the 50-day moving average coming in to provide trend support. The channel top acting as the new floor, polarity. The 88.6% Fibonacci retracement acting as the mathematical last stand. This is confluence. When three different trading systems, trend followers, moving averages, structure traders, channels, and math harmonic traders, Fibonacci, all see a buy signal at the same spot, the probability of a bounce increases dramatically. The article states that suggests that it should hold for now. The key phrase here is for now. Technical analysis deals in probabilities, not certainties. This confluence makes a bounce probable, but if a major geopolitical event happens or the US dollar spikes, this floor could still shatter. But as a technical trader, you play the odds. And right now, the odds favor the support holding at this level. The report also mentions near-term support is at Tuesday's low of $4,664, followed by the 50-day average at $4,530. Let's clarify these levels. Moving averages change every day. As time passes, the average price shifts. So, support is not a static line drawn in sand. It is a dynamic, moving target. Tuesday's low of $4,664 serves as the first minor hurdle for sellers. It's like a castle with multiple walls. The bears, sellers, have to breach the outer wall, 4,664, the inner wall, 4,530, and the keep, 4,402, 4,425, to win the war. Now that we have established where the safety net is, let's look up. How do we know if the recovery has started? We need to look at short-term signals and upside recovery scenarios. The report points us to a very specific indicator for this: the 20-day moving average. It states, short-term, the relationship to the 20-day average, now at 4,040 A's, may provide some clues. Why the 20-day? While the 50-day tells us the medium trend, the 20-day is the standard for swing trading. It represents roughly 1 month of trading activity. Currently, the price is below this level. As long as the price is below 4,848, the bears are still technically in control of the short term. This line acts as immediate resistance. The analysis notes, Wednesday successfully tested support at the 20-day line. Wait, this is a conflict in the price action described. Earlier we said price fell below it. This implies a battle. The price is dancing around this 20-day line. It crosses below, tries to rally, gets rejected. This chop, or noise around the 20-day average, is exactly what creates the uncertainty in the title. Traders are looking for a decisive move. A candle that opens below the 20-day and closes above it is a sign of strength. A candle that touches the 20-day and gets smacked down is a sign of weakness. The report gives us a bullish condition. A rally above today, S high, shows strength and might be followed by an advance above this week IS high. This is basic Dow theory. To have an uptrend, you need to break previous highs. If gold can muster the strength to push above the daily high, it triggers momentum algorithms. But there is a warning here too. The mention of the doji. If today was Friday, gold would be ending with a doji. What is a doji? Visually, a doji looks like a cross or a plus sign. It has long shadows, wicks up and down, but the opening price and the closing price are almost identical. What does a doji represent? Indecision. It's a visual representation of a tie game. The bulls pushed it up, the bears pushed it down, and at the end of the day, nobody won. Ending the week with a doji confirms that despite all the volatility, the market is unsure of its next direction. However, a doji at the bottom of a downtrend can be a powerful reversal signal. It means the selling pressure has dried up. If the next candle after a doji is green, bullish, it confirms the reversal. Before we move to the final part of our analysis, let's hypothesize on the scenarios the report outlines. Scenario A, the consolidation. Another scenario is that gold consolidates for a while below the 10-day average and above the 50-day average. This is the boring scenario, but often the most healthy one. Gold stays trapped between the ceiling, 10-day MA, and the floor. It moves sideways. It builds energy. This allows the moving averages to catch up to the price. It resets the overbought or oversold conditions, RSI. If you are a trend trader, you hate this. If you are a range trader, you love this. Scenario B, the second leg up. Remember the mention of the higher swing low. If gold bounces from here, let's say from $4,500 or $4,600, without touching that scary $4,402 low again, it creates a higher low. In technical analysis 101, a higher low is the first requirement for a new uptrend. This could result in a second leg up from the bottom. This means the move we saw previously was just leg 1, the pullback was the pause, and leg 2 is about to begin. Usually leg 2 is equal in length to leg 1. If that happens, we could be looking at new all-time highs. So the setup is clear. We have our floor at the confluence zone, 4,400, 4,425. We have our immediate ceiling at the 20-day average, 4,848. The market is trapped in between. In the final part of this video, part 3, we are going to calculate the profit targets. The report gives us a very specific upside target, $5,342. We are going to break down where this number comes from, explain the 78.6% retracement strategy, and give you the final verdict on whether you should be buying, selling, or waiting. You do not want to miss the price targets. Stick around. If the support holds, if that confluence zone we talked about does its job, where is gold heading next? The report gives us a very precise, very specific number, 5,342s. It states, nonetheless, a breakout of this week's high after this week will put gold on track to test the 78.6% retracement level at 5,342, the current upside target. Let's unpack this. Why 5,342? And why is the 78.6% retracement so important here? Usually when we talk about retracements, we are talking about the price falling back down, correcting. But Fibonacci works both ways. When a price is recovering from a drop, we use retracements to measure how much of that drop it can recover. A weak recovery stops at 38.2%. A moderate recovery stops at 50% or 61.8%. But a strong bullish recovery? That pushes all the way to 78.6%. The report is suggesting that if gold can break this week's high, it signals a massive shift in momentum. It means the buyers have completely overwhelmed the sellers who were active earlier in the week. Once that high is broken, there is often a vacuum in the chart, a space with very little resistance. The price can surge quickly through this vacuum until it hits the next major mathematical barrier. Think about the potential here. If we are currently trading around the $4,600 or $4,800 levels, based on the averages mentioned, a move to $5,342 is a massive percentage gain. We are talking about a significant rally. But, and there is always a but in trading, this target is conditional. The condition is a breakout of this week's high. You cannot just buy blindly hoping for 5,742. You need the trigger. The trigger is the price crossing above the highest point reached this week. That is your buy signal. Until that happens, 5,340 is just a dream. Once that happens, it becomes a probability. Before you go all in, we need to revisit a warning sign mentioned in the report, the doji. We touched on this briefly in part 2, but let's go deeper, because it defines the psychology of the market right now. The report said, if today was Friday, gold would be ending with a doji, confirming the uncertainty seen in the shorter timeframe daily chart. A doji on a weekly chart is a huge deal. Daily noise happens all the time. But a weekly doji means that after 5 full days of global trading, London, New York, Tokyo sessions, after billions of dollars exchanged hands, the market ended up exactly where it started. This screams indecision. The bulls tried to push it to the moon, the upper wick. The bears tried to crash it to the ground, the lower wick. Neither side won, the small body in the middle. When you see a doji, you should think of it like a yellow traffic light. It means caution. It doesn't mean stop, and it doesn't mean go. It means wait for the next signal. If the next week's candle breaks above the top of the doji, the bulls have won. The indecision resolves to the upside. That aligns with our $5,342 target. If the next week's candle breaks below the bottom of the doji, the bears have won. The indecision resolves to the downside, and we are likely heading back to test our support walls at $4,402. So, your strategy for the coming week should be simple. Patience. Don't try to predict the breakout. Wait for the market to show its hand. Let the institutional giants fight it out, and then you follow the winner. As retail traders, we are the pilot fish swimming alongside the sharks. We don't make the waves, we ride them. Okay, let's summarize everything into a cheat sheet. If you are trading gold, these are the levels you need to have marked on your chart right now. The danger zone, support, 4,664. Immediate short-term support, Tuesday's low. If this breaks, we go lower, 4,530, the 50-day moving average. The medium-term trend line, 4,402, 4,125, the fortress. This is the confluence zone, rising channel, top plus, 88.6% Fibonacci. This is the do or die level for the bulls. The battleground, resistance, 4,148, the 20-day moving average. We need to clear this to end the short-term bearish pressure. The 10-day average, we need a daily close above this to signal momentum, is shifting back to green. The profit target, upside. Week's high, the breakout trigger. 5,342, the 78.6% retracement target. This is where you take profits if the breakout happens. Having these levels is like having a map in a dense forest. You might still get lost, but your chances of survival are much, much higher. Remember, uncertainty, as the article title suggests, is only dangerous if you don't have a plan. If you know that a break of $4,400 means get out and a break of the weekly high means get in, then uncertainty vanishes. It just becomes a series of if-then statements. Now, I want to take a moment to address the final line of the article, which I think is the most important one. If you'd like to know more about technical analysis and how traders use it, please visit our educational area. Why did the author include this? Because charts are just tools. The real weapon is your mind. Everything we discussed today, moving averages, Fibonacci, doji candles, these are standard tools. But how you use them depends on your risk management. Even with all this analysis, gold could crash tomorrow due to news that isn't on any chart. A war could start, interest rates could change. That is why you never trade 100% of your account on one idea. Use stop losses. Position size correctly. Don't marry your bias. If the chart says the support is breaking, believe it. Don't say, but the video said it's a strong support. The market is always right. Our analysis is just an attempt to understand the market's language. Technical analysis is the study of crowd psychology. When we look at the 50-day moving average, we aren't looking at a magic line. We are looking at the average price where thousands of humans agree to buy or sell gold. When we look at the bearish reversal, we are seeing fear in real time. When we look at the bounce, we are seeing greed and hope. Understanding this psychology is what separates the gamblers from the traders. The gamblers are betting on red or black. The traders are counting the cards. So, to wrap up this comprehensive forecast, gold is at a crossroads. We have had a sharp, bearish reversal that shook the market. We have uncertain price action. But underneath that fear, we have a very solid foundation of support building around the $4,400 level. The 50-day moving average is holding the line. The channel breakout is being tested. The Fibonacci ratios are aligning. The setup for a bounce is there. The potential for a rally to $5,242 is real. But the market needs to prove it first. My advice? Watch the 20-day average, 4,148. If we reclaim that, the bulls are back in town. Watch the weekly high. If we break that, we ride to 5,342s. But if we lose $4,400, step aside and let the knife fall until it hits the next floor. Trading is 10% buying, 10% selling, and 80% waiting. Right now, we wait for the confirmation. I hope this deep dive helped you understand not just what is happening with gold, but how to analyze it yourself. We took a 200-word update and turned it into a masterclass on market structure. That is the power of deep analysis. If you found value in this breakdown, please smash that like button. It really helps the YouTube algorithm show this to more traders who might be panicking right now. Subscribe if you haven't already, and hit the notification bell so you don't miss our next update when these levels inevitably break. Let me know in the comments, are you bullish or bearish on gold right now? Do you think $402 will hold? Drop your thoughts below. I read every single comment. Until next time, keep your stop losses tight and your profits running. Happy trading.